Here are some important tax changes for Canadians in 2024 regarding TFSA, RRSP, CPP, and FHSA. Taxes are boring and nobody really likes talking about them that much. However, about 23% of a person's paycheck goes towards income taxes. So if you can reduce that amount even by a little bit, it sure helps. Especially considering Canada is right now going through a housing crunch / problems with inflation / cost of living concerns. For those of you new to my channel, welcome. I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada. I discuss all things related to personal finance and investing. I'll review changes in new contribution limits for short-term rentals, TFSA, RRSP, FHSA, CPP, lifetime capital gains exemption, tax brackets, basic personal tax credit. I've input timestamps into this video, so feel free to skip around to whatever part is of interest to you. Number 1, short-term rentals. This one has to do with housing and where there are housing shortages in cities such as Montreal, Toronto, and Vancouver, and there are short-term rentals such as Airbnbs. The Canadian government has announced changes that intend to deny income tax deductions for expenses incurred to earn short-term rental income, including interest expense in provinces and municipalities that provide short-term rentals. This will deny all expenses incurred on or after January 1st, 2024. Fraser said, "We believe there's likely tens of thousands of homes that could be made available to Canadians by addressing this particular challenge." The aim of this legislation is to put more needed housing back into the market for city residents so they can relieve the market of short-term rentals such as Airbnbs, as Airbnb units are typically rented out to travelers visiting that city for just a few nights and a part of the short-term rental market. There are roughly 235,000 short-term rentals currently, according to the Financial Post, listed on platforms such as Airbnb or Vrbo that could be used as housing. Studies overwhelmingly show that neighborhoods with high prevalence of STR listings have faster rising rents, lower vacancy rates for long-term rentals, and higher home sale prices. On a side note, there's also the Canadian Mortgage Charter, which provides some relief for homeowners struggling. I made a video about this very subject, which I'll link up above right here. One thing that I found very interesting is that the government is planning on maybe making changes or updating the alternative minimum tax rate. This means that if you earn over a certain threshold, you must pay a minimum tax of say 15% if you make more than $40,000. Over a certain threshold of $80,000 or $100,000, there is a minimum tax you must pay. I myself think this is a great idea and that it has merit, as it taxes the rich that they must pay a minimum tax over a certain threshold amount. There are of course still a few wrinkles that would have to be ironed out, such as if a person has a one-time claim of a sale of a property, this would thrust them into a higher tax bracket. But the idea has real merit that wealthier people would have a minimum tax that they would have to pay each and every year. Second, TFSAs. The TFSA limit has increased for 2024 to $7,000, giving people $500 more contribution room that people can make towards this account, which is all tax-free. When you receive your paycheck, you deduct your taxes and then you arrive at your net income. From this remaining amount, you take a portion of that and choose to invest it in a TFSA. While in your TFSA account, your investment grows tax-free, and you can also withdraw it tax-free. The government isn't going to tax this. Why? Because it's already been taxed before it went into this account, so they're not going to double tax it. If you make $100,000 and are subject to 28% in taxes, then from that remaining $72,000, you choose to contribute $5,000 and put it into your TFSA. Then say in 3 years, you withdraw all that money, but because of your investments, it's now turned into $6,000. You can withdraw that full amount of $6,000 tax-free. And all of it can be withdrawn and invested tax-free as long as you're below that annual contribution limit. A TFSA can hold a variety of investments, including cash savings, securities listed on a designated stock exchange, guaranteed investment certificates, GICs, bonds, and mutual funds. If you don't hit your TFSA limit that year, the unused portion is carried over to the next year, so you don't lose that unused portion. If you've never opened a TFSA account before, it can be quite a large chunk of change. You get $95,000 contribution room, provided that you were 18 or older in 2009. All Canadians receive the same amount of TFSA room, and the amount contributed is dependent upon your age and not the income you earn. These amounts on the right are the total amount that you can contribute to your TFSA over your life. If you were born in 1991 or earlier, and you are now at least 33 years old, you can contribute up to a maximum of $95,000. If you just turned 18 this year in 2024, the maximum you can contribute is $7,000. You need to be at least 18 years old in most provinces to qualify. In some provinces, it's 19 years old. For people new to Canada, you do not have to be a Canadian citizen or a Canadian resident to open a TFSA. However, you do have to have a social insurance number and be living in Canada to collect on the interest earned. For new Canadian residents, look into the year that you actually moved here, and that is when you start your contribution room. From that year, it is not dependent upon the year you were born as it is with Canadian citizens. If you moved here in 2021, then your total contribution room is $25,500, even if you are older than 21 years old. Finally, yes, you can open more than one TFSA account. However, it must be at a registered institution certified account, and you cannot exceed your annual contribution limit. Otherwise, it's subject to a 1% penalty on the amount over the contribution limit. Any income you earn in your TFSA does not reduce the amount you're allowed to contribute. You can find your TFSA contribution room by logging on to the CRA My Account for Individuals website. This is a very powerful tool for Canadians in building wealth, so please open one and use it.
Do it. Do it now.
Third, RRSP, Registered Retirement Savings Plan. There is a contribution limit to RRSPs, which is the lesser of 18% or the annual contribution limit. So for example, say you earn $2 million a year. You don't get to contribute 18% times $2 million equals $360,000 to your RRSP. Sorry. RRSPs in regards to taxes work the exact opposite of TFSAs. Every year, you build contribution room equal to the lesser of 18% of your earned income, or the yearly max, which is $30,780 in 2023, but will be increased to $31,560 in the 2024 tax year. So $31,560 will be the maximum for 2024. Any unused contribution room or amounts that you have in your RRSP gets carried forward indefinitely to be used in future RRSP contributions. So don't worry, it's not a use it or lose it rule. The total amount you can contribute to your RRSP each year is made up of your contribution limit for the current year plus any carry forward contribution room from previous years. However, remember that if your employer has group RRSPs or deferred profit sharing plans, that reduces the amount that you're allowed to contribute to your RRSP. Your earned income is composed of the income you bring in from your job, any business income, and any rental income that you may have. However, earned income does not include any investment income or capital gains income. So for example, you have $8,000 carry forward from previous years. A $70,000 salary allows you $12,600 to be contributed to your RRSP plus $8,000 equals $20,600 that you can contribute in total. You can have more than one RRSP account as long as you don't pass your contribution limit, which is $30,780 for the 2023 tax year, plus any carry forward RRSP contributions from previous years. Like I said earlier, your RRSP contribution room is dependent upon your level of income and not on your age. They work the opposite way that TFSAs do. This year is actually a leap year, so the deadline to contribute to your RRSP is actually February 29th, 2024. It's always 60 days from the last day of the end of the year, so please don't wait until March 1st, 2024 to make a contribution to your RRSP, as you'll be too late. A very smart thing to do is if you know you're going to be bumped next year, say, into a higher tax bracket because maybe you have a big raise coming, Wait until that year to make a large RRSP contribution, because this will bump you down into a lower tax bracket and you'll end up paying less taxes. Hey, if you feel like you're getting something out of this, please hit the like button and consider subscribing if you want to learn about personal finance and investing from a 20-year corporate accountant. Fourth, FHSAs, First Home Savings Account. This was first introduced in 2022 and is a great thing for first-time homebuyers as it's trying to assist them in purchasing their first home. It takes both the benefits of the RRSP and TFSA and combines them together, so you actually get the best of both worlds. Whatever amount you choose to contribute to your FHSA account is taken out before taxes. It is never taxed by the government. Then when you invest and eventually withdraw that money, it is also never subject to tax. It is money that is deducted from your paycheck, invested, and then withdrawn, and is never subject to tax. So this is a great thing for first-time homebuyers. However, remember that if you transfer from your RRSP to your FHSA account, that is not deductible. The annual limit is still $8,000, and this is the lesser of either all your annual FHSA limits, subtracting your annual FHSA deductions, or $40,000 minus the total of all your FHSA deductions each year, minus all amounts transferred from your RRSPs to your FHSAs for the year and each year prior.
Again, first home savings account, great opportunity to save for the first home. The only qualification is you must be a first-time home buyer, resident of Canada, 18 years of age, and that means that you don't own a home in the current year or the previous 4 calendar years.
Here's a link to the Government of Canada's website for information on this very thing, and I'll also put a link in the description below. All of the big 6 banks now offer FHSA, including RBC, BMO, CIBC, TD, National Bank, and Scotiabank. Other financial institutions include Desjardins, EQ Bank, Questrade, and Wealthsimple. One final tip is that if you're thinking about opening an FHSA account, do it as soon as possible, as you can use that carry forward to the next year. So if, say, you opened it in late December, you could use that unused contribution and carry it over to be used in future years, which is a great thing. In order to qualify for the FHSA deduction for that tax year, it must be opened on December 31st in order to count towards that year's contribution and taxes. Number 5, CPP, or Canadian Pension Plan. The Canadian Pension Plan is a program for retirement that all provinces pay into, with the exception of Quebec, that helps them save for retirement. Starting January 1st, 2024, the amounts are not only changing, but increasing. Starting in 2024, a higher second ceilings of $73,200 will be implemented and used to determine second additional CPP contributions, CPP2. As a result, pensionable earnings between $68,500 and $73,200 are subject to CPP2 contributions. I'm not happy about paying more money towards the government and in taxes, but if it helps hardworking Canadians have a better retirement, I'm all for it. Number 6 is the Lifetime Capital Gains Exemption, LCGE. This is the most important thing and can save a significant amount of money for a person who can sell something and earn money from a capital gains exemption from a qualified property. For 2023, this number is $971,190. When the number 2024 comes out, the general consensus is that it'll be around $1 million, a little bit over or under. As I said, not a lot of people know or will use this feature, but this is a great thing if a person, say, sells a business and can save them quite a bit of money. Number 7 is our tax brackets. The tax brackets have actually shifted so that more income stays in the pockets of low-income earners. The rates have remained the same, the tax percentages, but the ranges have shifted at the federal income tax level. Number 8 is the basic personal tax credit. This credit for 2024 is $15,705, meaning anything below this amount you'll not be taxed federally on. This really helps out people that are working part-time and students as well. You save $15,705 times 15% equals $2,355. That can really add up. This is money you save that would otherwise be going to the government. So to sum it all up, people earning between $50,000 and $80,000 will will see a slight decrease in their taxes, even though their CPP payments and contributions will be going up. The savings for middle income tax earners will be about $150 to $300, primarily due to that upward shift in those tax brackets that I mentioned earlier. Lower income earners will be paying roughly the same amount, maybe even a little less than they did last year federally. Of course, the taxes you pay depend on what province you live and what provincial tax you have, but every little bit helps. Remember that the deadline to file your 2023 taxes is Tuesday, April 30th, 2024. However, if you or your spouse/common law partner are self-employed, your deadline to file your taxes is June 15th, 2024. Penalties and charges for late tax submissions are 10% interest on overdue taxes, late filing penalties, 5% on taxes owing, plus 1% for each full month your return is late, to a maximum of 12 months. Like I said, I'm a 20-year corporate accountant and analyst living in Western Canada. So if you're interested in personal finance and investing, please consider subscribing. Thanks.